Good afternoon, everyone. Welcome to the TheoTrade afternoon video. I'm Blake Young, and today is May 18th, 2023. And today we're going to ask the question, who's afraid of more rate hikes? As we look at the market today, we can see that we are trying to be bullish, but we're still stuck in the exact same range that we've been at for months. This is a 3-year chart on the SPX. And if we're to go and look at the economic data or the news reports pre-market and throughout the day, we would see that the Fed, at least multiple members, including voting members like Fed's Logan, doesn't yet see a case for June pause with prices still high. So the Dallas Fed chief is saying inflation is high enough that the Fed really should not be even considering a pause, that we have to fight inflation. Fed Jefferson also suggests he's willing to be patient on policy as well. So we're seeing two of the Fed members saying we are still seeing inflation, we're still seeing no justification to a rate pause, and therefore we probably ought to be looking for a continued rate hike policy. If we go take a look at what Bullard said today, Bullard suggested higher rates as insurance against inflation, meaning that we need to continue to be hawkish, we need to continue to be raising rates because inflation has not stopped. The expectation of higher rates in June, and possibly ongoing, are not just exclusively to today. They're not being driven just by today's news. It's because we continue to see CPI and PPI show that the numbers are still high. We're still in the high fives, possibly even low sixes, as we're talking about inflation. And as we're looking at inflation and higher interest rates, the US dollar has started to strengthen again after months of being flat near support. The US dollar is gaining and breaking out. So when we look at the idea, who's afraid of these rate hikes, really we're asking which assets are going to be sold off if we're going to see rate hikes. And going back to the same things we've been talking about over the last couple of days, actually the last couple of weeks, and paying attention to the SPX, this is a 3-year chart. We can go back further, we can go closer. What you're going to see is a high correlation or an inverse correlation to the US dollar and equities. One of the things we have to pay very close attention to is the SPX, the ES futures, the Nasdaq, the Russell, gold prices, house prices. All of these are directly correlated to the dollar's purchasing power. They're inversely correlated. So as the dollar loses purchasing power, all these assets go up in value compared to the US dollar. But when the US dollar is gaining, these assets have a general behavior that they should fall, they should sell off. And as we're watching this expectation of higher rate hikes, if the dollar is going to continue to gain, then we should see equities fall. Now let me show you a quick comparison between equities and the US dollar. We'll just keep it to the SPX and the dollar index. So to start with, we're just going to go to studies, edit studies. I'm going to do a comparison chart. And with the comparison chart, we will change this. Let's change it to the dollar index. This is the dollar versus a basket of currencies. And we'll change it to a candlestick so we can really see the daily moves and the expansion, the contraction of these markets. And so taking a quick look here, if you'll note when the market turns versus when the dollar turns. Notice the peak in the equities is also the low in the US dollar. And we look at the major turning points, if you can either go with one or the other, it doesn't really matter too much. But if we go with the dollar first, if we say, when does the dollar turn? And we can look at where these points pivot. Let's go ahead and mark this chart with a time level. And so if we're looking at this, when did we pivot here? Notice we pivoted at the exact same time. The exact low, the big solid red candle or solid candle for the dollar, was the high candle for the equity market. Same thing here. When the dollar bounced and reversed, this is the down candle, the up candle. That was a major sell-off of equities. And when the dollar reversed and sold off, that's when equities took off. And we can go through and find every major turning point as another indication or a move opposite direction generally to what we're seeing in US equities compared to what the US dollar is doing. When the dollar bounces here, equities sell off, and we do that for quite a significant move. This is not a small move. Again, this is a weekly chart. And we can go through and we can mark all these major turning points all the way through and saying, where did the dollar bounce? Where did it sell off? When did it pivot? When did it reverse? And as we're looking at these major reversals and these drops and these climbs, well, 2 weeks ago, you can see these candles here. This is the dollar index. 2 weeks ago, the dollar hit a low, lowest close it has been in, not just for this time period. Looking back, this is the lowest weekly close the dollar index had had going all the way back to October of 2022. So as we're looking at this low, the lowest close we had, we reversed, we rallied, and we've rallied. We have 2 solid weeks of growth in the US dollar. The dollar's climbing aggressively after finding its support level. And yet equities aren't following the historic high inverse correlation. We're seeing US equities push back to the same high. When both equities and the US dollar rally together, there's 2 things that are going on. One is money's moving into the US dollar, money's moving into US equities, but this is a bigger indication that money is moving away from foreign assets. It's moving away from foreign currencies. It's moving away from the euro. It's moving away from the pound. We're seeing money flow into the United States and going into both US equities and into the US dollar. So this move up in the US dollar, at the same time we're expecting higher rates, it is a flight to safety, a higher interest rate, potentially, in the US and away from other currencies, away from other stock markets, and even away from gold and some other safe, quote-unquote, assets. So when these move together, when you see the big bullish candle move together, when you see bearish candles move together, don't think of this as money moving in and out of the US dollar. Think of this as money moving in and out of the US economy. And so when they move together, it's usually a flight to safety into the US or a flight to safety away from the US when they move together in the same direction. But you can see almost every single candle, they are moving opposite, 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 opposite. It's when they move together, like here, and then they move together, like here, that you'd say money moved into the US and then continued in US equities. Money moved out here, both US equities and the US dollar. And those moments are actually a disconnect or a fundamental intermarket divergence. And they usually, within the week, get back to the same historic correlations. And that means the next candle, we expect them to be back in line. Now, if the US dollar is going to continue to gain, then equities inevitably will fall if we go back to our correlations. Let me show you the correlations as a mathematical number rather than just looking at the charts and these pivots. We're going to go into the studies, edit studies, and add a correlation study. If you're familiar with correlation study from Excel, then this will be familiar to you already. But we're going to compare the SPX here to the dollar index. And we're going to look at it based off 10, which means in this case 10 weeks. We'll change it to a shorter time period as well. But if we're taking a look at this and making comparison, we're looking for this very high correlation between 1 and -1. And the inverse correlation is going to show from 0 to -1 that the US dollar and US equities have a very long history, not just last year, not just last 3 years, not just the last 10 years, a very long history of being inversely correlated to equities. There are moments that we disconnect from the inverse correlation and they move together. That again is, if they're going up, it's a flight to safety in the US. If they're going down, that means running away from the US economy. Right now, you can see we're currently at 60% correlation, meaning if the dollar gains, 60% of the time, equities should be losing. And we were as high, if you look at the number here, we were as high as 93% correlated just last week. You go back through here, 94, 93, 94, 92, 95% correlated that if the dollar is gaining, equities should be falling, or vice versa. If we change this to a 10-day time period, meaning we're going to look at the 1-year daily, you're going to still see the pivots and the turns are going to match up. And then if you look at the correlation here, again, we get to -100, we get to, or well, -96. And right now, we're dealing with multiple days, multiple weeks, dealing with this disconnect, this fundamental inverse correlation divergence. And after this time period, when they get back in line, we can expect a probably aggressive, sudden move on either the dollar has to sell off or equities have to sell off. That's what will happen to get the correlation back to where it's been for decades. And so the move together today, the move together yesterday, this is a flight to safety in the US. And we're seeing that disconnect that has been here all the way back to April 24th. So we have a very long time period of disconnect, 3 weeks really, of disconnect of what is a normal historic inverse correlation between US equities and the dollar. So this rally isn't as much of us being fearful of US equities, it's the world being fearful of what this means next. And that could be, is the world afraid of the US default? I don't know. It would be catastrophic, not just to the US, it would be catastrophic to the world. And as we're seeing the dollar again, remember what we've talked about in the last couple of weeks. The supply of money has compressed more in the last, really from the absolute peak here. Absolute peak was January of 2021. The amount of money in the markets, the amount of money in deposits was at a record highs, and we've had a more significant collapse, pressured to the downside, and reduction of supply from its peak than we have ever in the history of the United States. This contraction from year over year, year over year, year over year of money available to the supply that is available has reached a 60-year low, pushing us back into these levels, and we're at negative 8% year over year and way off of these highs. Now, again, this doesn't mean there's no money, but it means the perceived or relative supply of US dollars is going away. The access to supply is going away. So if we have no supply of dollars, the value of the dollar has a tendency to go up. Anything that you have low supply on while maintaining demand will have a higher perceived value. And so this massive movement, if you want to see this from a traditional move here as far as in billions, you can still see that we're so far off the peak. We have erased, as far as money supply and access to money, we've erased all of the 2020 spending. We're back to April of 2020 levels. Now, we had a huge spike going into that, but we are at the same level as we were as we began the lockdowns, as we were discussing the ideas of how can we put more money. We've eliminated that supply. It's gone. And the correction that we're seeing here is the biggest drop in money supply in history. Brandon and I talked about this at the close yesterday, that the market forecast gave us two bearish clusters here at the peak, told us to go short. We had an intermediate confirmation, a breakdown, and we've continued to sell off. And this sell-off, this reversal, is a pretty clean reversal. It is a clear peak. We've dropped down to this level. We create another peak. We could easily fall all the way back down to these levels and push us back down to March lows. That is a March high, or 2022 high for the US dollar. So the US dollar could reach 2022 highs, which theoretically could tell us we could see equities hit 2020 lows. Now, 2020 lows for the S&P 500 is 3,600, and that is a target I've been watching. If the US equity market gets behind its historic inverse correlation, a drop from 4,200 to 3,600 is possible. And if we look at the response that the market has put out as far as probability of that rate hike and probability of a stronger dollar and probability of higher cost to borrow, we went from a 90% potential, well, 89.3% potential of leaving rates unchanged by June to a 64% chance of leaving rates unchanged. So basically a lock at 90% probability 1 week ago to now a 35% chance that we're going to see a rate hike. What went from a 10% probability of a rate hike to a 35% probability of rate hike. So we're absolutely shifting our probabilities from a lock of 90% to a standard deviation, which is still a high probability. But this shift is dramatic. We're unwinding the pause and accelerating the next rate hike. And higher rates means higher demand for the US dollar, and higher demand for the US dollar and bonds will also tell us we have higher demand while dealing with lower supply. Unless you think that I am not taking into consideration the inflation data as well, the Fed fighting inflation removes the need, or at least the perceived need, to hedge against inflation. Gold prices reached its annual peak at 2,085. Today, while the dollar is gaining, gold prices have fallen and erased all of the bullish move going all the way back to the most recent lows back on March 21st. These are all highly correlated. A break of this support level could see the same price pattern repeat, and we could be looking at 1850 by the time we reach that June rate hike. So when I ask the question, who's afraid of more rate hikes? Apparently bond holders or bond buyers are afraid of rate hikes, and we're pushing down to the lows. Gold owners are pushing down to their recent 2-month lows, as we already pointed out with gold prices. ZB, longer term bond holders, have already broke through that level and are continuing towards our March target. And we will likely see equities follow in suit. Short-term equities and bonds move opposite. Long-term, they move in sync. If you were to look at the two in the correlations, they generally rise and fall over time together, but in the very short term, they're moving opposite. And so we will likely see a sell-off in equities, we'll likely see a sell-off in bonds, we'll likely see a continued sell-off in bonds and in gold prices if the dollar is going to continue to gain. As we go back into that dollar index one more time, what are we looking for as far as the top target for the US dollar? Top target for the US dollar in the short term is about 105. So the move from 103 to 105, being just shy of 2%, sets us up to see a 5 to, let's call it 7.5% drop in US equities between now and mid-June. Now, I do think probably your best short opportunities will be in consumer discretionary and in technology, as they will be the ones hit hardest by rising rates. And as we're looking at technology, we just reached a record high, or at least a yearly high in technology today, which only gives us that much more opportunity to fall back if we see that correction. Right now, this is being lifted by the monsters, and we can still see it sell off before we hit June. We could see it drop back down to 144. The one that is already moving is real estate, and real estate is already back down to its short-term support. It looks very much like bond prices, and so I'm looking at real estate to fall back to about 34.50 before we hit that June price. Now that's about 7% there as well. That's going to do it for me today. Have a great day, everybody. We'll look forward to talking to you next week.